Hi, this is Randy Finney with Right Side of the Chart, and this is a early session update for Tuesday, March 7th, 2023. It's 11:30 a.m. as I'm starting the video, so we're 2 hours into the trading day, and I want to just stick with the markets on this one, do a quick update there, and try to gauge where we're going to go from here. That's always the most important thing. All right, so let's just kind of recap the last couple days, or really last couple weeks. That's what we're going to do here. Because I do want to speak again to the recent breakouts and the recent bullish developments that we've had on everything from the intraday charts here, the 60-minute charts, these bullish falling wedge breakouts. Remember that we had those wedges and positive divergences on both the futures and the ETFs. That's SPY, QQQ, the big caps, the ones I watch, and the ones that are the market really. So that we went full circle, as I covered recently. We rallied up to the downtrend lines, gave us a textbook short entry right there. I mean, we nailed that one yesterday, right at the trend line. Nice pullback. First target was hit. There's the typical reaction off T1. If you're an active trader, you could have gained that. And then now T2 was hit. We had a brief momentum fueled overshoot, and we're still below it. And the way that, remember, the way that technical analysis works is support, once broken, becomes resistance. So at this point, that 298 second target is actually resistance, because we shot down below it. That was on Powell's comments today. I'm going to talk a little bit about that. I'm going to just briefly touch on fundamentals, and then going to give you my thoughts on the market. So that's it. So we're below it, shot down below it. It gave you an opportunity to cover, and or if you're, like I said, on that trade yesterday, there's certainly the potential for more, and I'm going to talk a little bit about that in this video. That's really what I wanted to get into. So there we are. Just to jump over to the website here, under the post that I put out there today when that second target was hit, Jeff had asked, nice buy the dip opportunity. Do you see return to the uptrend? I'm assuming to the uptrend line with higher highs now that the pullback has occurred and the supports have been tested. My answer, and I'll read it here, and I'll kind of get into this in the video real quick. Yeah, I just can't say with a high degree of conviction. On one hand, the breakouts and subsequent back tests of the key 200-day simple moving averages on QQQ and SPY, as well as the primary downtrend line on SPY. Remember, we also back tested, made a perfect back test, successful back test of that. That was all 100% bullish, as well as the bullish engulfing candles we put in on Thursday when we did that. So that is absolutely nothing but bullish as long as that stands. Now, I went on to say, however, if, and that's in big letters, if there's going to be another major leg down in the bear market soon, then you really couldn't come up with a better catalyst than to see the market go on and now, from this point, make a solid failure back down below those levels. I'm talking about last week's lows, because that would mean, as I've been talking about recently, this whole breakout, nothing but bullish. I came across an article, some of the pundits said the same thing, kind of what I was saying. They broke out above, markets pulled back, tested those key levels. I didn't really get into the nitty gritty of what they were saying. I'm assuming they're talking whether it's the trend lines at 200-day or even price support they're looking at, and their takeaway was because there were several tests and then the markets moved away, that means the market's going to go higher for a matter of months at least, or for a while here, not just a quick. So now, where I'm going is, that's what should happen. That's what, again, it was a textbook breakout and textbook back test. And not only that, like I said, they gobbled up the last back test impulsively, meaning rallied off there from Thursday into yesterday's highs, bullish engulfing candles. I'll get to that in a second. Now, if you're going off, or let's just assume, play market agnostic here. You're not a bull nor a bear. You're just looking at it. Assume that we're in a bear market, or if we are in a bear market, then there really couldn't be a better setup than to see all those breakouts fail, because they shouldn't, because that was, again, completely bullish. So you have to assume, and I think this is a safe assumption, a lot of traders, especially professionals, institutions, or retail traders that really been doing this for a while, read the charts, see those breakouts, see those back tests, and they feel it's safe to get back in the water. And they've been getting in the water. So again, those lows should hold, and that's really last week's lows. And if they don't, then that has the potential to be a very, very bearish thing. In other words, a failed breakout. So here, I just can, I wrap that up by saying I'd put nearly equal odds that we can go up and rally from here and make those marginal new highs. Don't get too tied up in the headlines. Yes, Powell came out more hawkish than expected today at 10 o'clock. That's what set the markets down, saying that they're going to raise rates probably more than they already expected to, or the market expects. But look, everybody's kind of getting used to this hawkish speak. And I'm going to get to that in 1 second, talk a little bit about the fundamentals. So let me just get back to what I was doing here. I said I'd put nearly equal odds, but with a slight favor towards the bearish scenario. In other words, what I just talked about, that recent breakout fails. And here's the thing, you don't have to, whether you're in that same camp or not, the thing is to react to it. You can certainly position ahead of it. You're going to have a more favorable short entry if you short, up here before the breakout happens, because we're going to go down a little bit. I'm going to get to the chart in a second. But the safe bet is to not be, and I've been saying the same thing for weeks, as a trend or an investor. If you're positioned as a long-term swing trader, you're looking out months, or a trend trader, really can't make a strong case to be aggressively short until and unless those breakouts fail. Okay, so that's that. You can always take a position, or you can just wait until it happens. I haven't refreshed the page here, but I posted this, which I'll get to in a second, just for active traders. Nice level to reverse back to short for those that covered that initial tag. And it's also a momentum fueled overshoot of T2 on QQQ. A momentum fueled overshoot, for those of you new to the site, is a term I made up, and I've been using it for years. When you have a lot of velocity or momentum heading into a support level from above, and that would be this downward move, or on you're heading up and you have a lot of momentum to the upside, you tend to have that momentum tends to carry things forward. And you tend to briefly overshoot the support level that's there, only to snap back. I always use that analogy. Pitcher throwing a 90+ mile an hour fastball, hits the catcher's glove. The glove, his wrist is going to snap back. The glove will from that point, but then it'll spring back forward after that and come back to where the ball made contact. So that's kind of what that is. Now, as I told you before, we did a momentum fueled overshoot. We tried to pop above there, but we're still below it. So that gives me right now a bias to the downside. And then that setup I just was showing you, I got out to you as quick as I could this morning. That was at 10:38 a.m. Nice level. This is just a 5-minute chart. I've told you many times, when I'm actively trading, I'll go down all the way sometimes to the 1-minute charts, but the 5s, 15s, those are some of my favorites. And so this was the NQ here, the Nasdaq 100 futures, my preferred trading proxy. We had that divergent high yesterday. That's that rally we faded. That's where T1 was hit on QQQ. We had the typical reaction, and then as often is the case, that's why I list multiple targets. When you can trade bounces off those initial targets, and it's also support. So once that support gives way, so this morning, it happened fast, but you could have had a sell stop order in if you didn't have a position, or you could have just recycled back in short after the bounce. That would have been the prudent thing to do, and swing down to T2. But there was a perfect rally back into, and it's still here. I'll give you an updated chart. That one's a little dated now. That was a 5-minute chart right here. And that was it. So boom, there was that little re-entry. So you covered today on T2, gained the bounce. Again, active trading stuff. And this was, remember, this, even though we're looking at a 5-minute chart at NQ, that was T1 on that QQQ 60-minute chart right here that I gave you yesterday. That aligned with it about 12. I think that's 12.311. And then that's it. So this is active trading. Wash, rinse, repeat. Now, where do we go from here? Well, all right, let's talk about that real quick. I am going to jump back to the 60-minute chart that's kind of started all this. Remember, we have this downtrend line that's still a significant level. If the bulls can rally back up, here's the way I would look at this right now. If you want to keep this, the old KISS rule, keep it simple. Right there is the recent highs from yesterday. It's also it's a reaction high, number one, and it's also the downtrend line, that near-term downtrend line we shorted at. Then this is the recent lows right here from last week, and that was a divergent low. And so those are the two levels. Again, this is I risk oversimplifying things here, but pretty much bearish and short below that for a larger move, not a little 1-2% zigzag active trading stuff. I've told you I went to active trading mode recently because that would be, I believe the charts would be more conducive to that. So you've gone nowhere if you've been a swinger trend trader, because you're back where you were here in the end of late January. Right now is where we're trading. Again, this 60-minute chart. And then if we take that level out, that's going to increase the odds for that marginal new high scenario. So here we go out to the daily chart of QQQ. That marginal new high scenario would look something like this: an equal or slightly higher high there to put in negative divergence on the indicators. I'm leaning less towards that, as I said, read those comments that I made a minute ago, that may be it. And SPY is really the one. A lot of traders, just about everybody, watches the S&P 500, as you should. And the story of that is, here's our bear market, a beautiful, well-defined bear market downtrend line, and there's our 200-day in blue, a simple moving average. There was a breakout. There was that textbook back test for 1, and then came back 2, 3 days, and there, as I mentioned, there were bullish engulfing candles on that last back test. We rallied hard off the 200, rallied hard the next day. They were gobbling it up. And look, all this is at this point in time, it's just a pullback. You really, forget about how impulsive it was, and Powell said this, and the market wasn't expecting that. Again, he's been getting more hawkish and more hawkish. Powell's always wrong. The Fed is always wrong. I was the biggest critic of Powell back before he pivoted, when he kept saying inflation is transitory, until it was blatantly obvious that it wasn't. And it's not just Powell, it's his predecessors before him. They all tend to be reactive, not proactive. He's trying to now, because of the risks on the economy, and I'm going to get to that in 1 second, he's trying to be proactive, and he's wearing, he's not in his usual skin. He's a dove by nature, as every chairman that I can remember, going back to Bernanke and before that, were excessively bearish. I mean, dovish, meaning keep rates low, and too low for too long, and that's that. All right, so that's it. There's the recent lows from last week. Like I said, if we take that out by a good margin, remember the downtrend line is going to come in at lower and lower levels. And as I said, it's not an all or none thing. It's not binary, 0 or 1, where 0 is bullish above there, 1's negative, or just all or none. It's incremental. Certainly the first move down below there, especially a solid close, would be bearish. And then likewise, same thing happens this way. If you rally back up, take out the trend line, it will increase the odds, and it'll increase the odds pretty substantially that we're going to go up and at least get that marginal new high scenario. So yeah, I just told you the market can go up, the market can go down. I don't know, but I'm not betting either one of those scenarios. I'll sit here and game the little zigs and zags all the way down. If it's going to do, this, let me grab my arrow tool. If it's going to do this, it's not going to do that straight from here. It might start to accelerate. I think it would here, and then I'd be more into swing trend trading mode. And if it's going to work its way up, it's probably also going to zig and zag, although there'd probably be a breakout above the trend line if that happens. Then that might be a more impulsive move, and maybe a little swing or trend trade up there to take out those highs. But as of now, I'll continue to live in the world of these intraday charts. And first thing I'm watching, is for a solid recovery back above 401.33. That was that comparable support. I give you 2 targets on SPY as well. The other day I had them labeled. The labels fell off here, or they're not on this board. T1 was there, 401.19, and T2 right here. And so just like QQQ, we took out T2 on that momentum field overshoot. We back tested from below, and that was also coincided with that objective short entry I posted out when QQQ and SPY rallied back. And there we are, bearish crossovers on the 60-minute PPO. And now let's talk briefly about fundamentals, and I can wrap this up so it's not a super long video. Alrighty, so this is, let's go talk mortgage rates. You know, the whole thing about inflation. Inflation's bad because the cost of goods and services go up. You know, everything from a can of soup to you know, a car or a house, the cost of your mortgage. And mortgages are, we all know that's typically one's biggest expense is rent or mortgages. So obviously they're going to go hand in hand. House prices are high, rents are going to go high. So we know that the last hyperinflationary environment, the only parallel we have to the current inflationary environment, even close, was back here in the late 70s, early 80s. We had runaway inflation and like hence, of course, increasing interest rates, right? And we also had a very bad recession back in the 80s. A couple of them, really. You can see early 80s and then again in the early 80s, bigger one, the shaded lines here. Now, okay, so what happens is high interest rates, and this is basic 101. I don't want to get too much into this. You know, higher rates are just restrictive to economic growth. The cost for you to buy a car, a house, or for a business to expand, open a new plant, buy new trucks, equipment, whatever it is, it becomes more restrictive. Higher rates go. And as I've talked about many times, and one reason for my longer term bearish outlook is cyclical trends. We were in a secular bull market and rising interest rates, and that peaked in the early 80s, and interest rates have steadily and slowly been falling until recently. Now we're in, again, an inflationary environment that has no parallel in recent history until you go back here, you know, over 40 years, right? Okay, so we can all agree on that. Now, okay, so the glass half full. The bulls might say, you know, or those being bullish on the economy might say, okay, well, interest rates, sure, mortgages shot up and they were recently peaked at about 7% on a 30-year mortgage. That's what we're looking at here, guys, if I didn't say it, 30-year fixed rate mortgage. And then we had a little abatement, a little pullback, but we're still up high. We're still at 6.65 in the, you know, recently, so almost 7%. Now, historically, when you look at that, you say, yeah, no big deal. People can afford a 7% mortgage because they were doing it back here and they were doing it here, and they even had higher than 7% mortgages here. Okay, the thing is that what you have to look at is how long and how low rates were. And what happens is people, business, the economy, the whole machine of economics and both individual businesses, they get accustomed to and work around low rates. So in other words, it wasn't as if we went from 10% mortgages, and if we did that and all of a sudden the Fed did everything they did in COVID, took rates down to zero, and then we shot back up to 7%. You know what? Everybody would be fine there because the world hadn't gotten used to low interest rates. And this is, again, this is my opinion. That's how I think economics work. So had that happened, had we gone down here to, you know, 2.5% mortgage rates and then shot up to 7, if it was a blip, it would be fine, and I don't think it would slow growth. We'd have to start getting above the, you know, the mean, the average, the trend to really start putting a damper in things. Now I'm speaking again right now to macro economics, longer term stuff that I believe hasn't played out. I am acutely aware that the consumer has been surprisingly resilient, relatively speaking, even though the, you know, sentiment surveys are getting a little more bearish. They are still spending. Economy is still humming along, and I fully acknowledge that. But I would be surprised, and let me show you something that I did here. So when I see rates go back here, so rates were hovering around 8% for a mortgage back here in the mid to late 70s, early 80s, right? And then they really shot up. This is where inflation just really started running away. And you can see mortgages peaked at about 18.5% right then in the early 80s. Now, when you go from 9% to 18, that's a double, and that's high, and it crushed the economy. It put the brakes on, and it doesn't happen right away. There is a lag time with everything. Now, keep in mind, down here, you went from, you know, just over 2.5 to 7. So you did more than a double. And the way to look at that is if you change it, instead of looking at what the actual mortgage rates were, look at the percent change from a year ago, which I just did. And now, let's get rid of that. Look at this. And this is where I was going. Again, we're coming off a period of not just historically low. We had persistent low rates for many, many years, down near zero, really since the financial crisis. They took it down. So this shows the rate of the change from a year ago. This will, in my opinion, or everything I've ever known to be true about economics, it is going to play out, and it's going to play out hard. And it's going to play out for as I've predicted from day one, a much slower bear market, a much slower but more prolonged and deeper recession than any that we've seen in over 40, almost 50 years. But again, it's going to take a while to play out because the Fed there's still so much stimulus and cash and things floating around the markets. But I just wanted to point that out. I want you to look at this visual because this measures the change in percentage term. Remember, rates more than doubled. If they had gone up 100%, you'd be, there's the 100% mark. And so I'm just trying to compare it to that period back, which up until then was unprecedented, the biggest rate of change, or the biggest percentage increase in interest rates. Again, not over the actual rate, but percentage increase from where the rates were, and that crushed the economy. And I struggle to see how this won't. And you can extrapolate the same chart over to all types of loans, whether it's personal loans, second mortgages, home equity lines of credit, things like that, boat loans, again, business loans, and everything else. So that's macro. You can, if you're going to do anything, you just kind of formulate this and kind of put it in the back of your head for longer term. And it going back to the charts, it plays into everything. I did a video just last week covering the longer term charts, the S&P 500 and everything. I went out to the monthly charts and showed how we continue. And I said we're getting long in the tooth for back testing, and we still are, but we're still below that 20-month, that blue dash line, one of the best, historically, unarguably, one of the most reliable and simple indicators. Markets in a bear market when you're below it, and you turn off all lines, and you're in a bull market when you're above it, as we were from pretty much, with very few exceptions, from back here in 2009 up until here at this point. And again, we had monthly candles, one-time blip, recover the very next month. There wasn't other than right here, you had just two very slight moves below it, but again, recovered by the following month. This is a clear breakdown and clear back test. And so I'm still favoring this scenario. I still think we're very close. And then to just kind of take this video home, that where I started out, I can't promise, or I can never promise what's going to happen. I always will give you my thoughts, right or wrong, and I'll kind of tell you, I'll always work to tell or try to convey my convictions, how high or not high they are. And I am leaning that way. But again, it has to happen because, as I said, if you want to, you can have whatever bias you want, and my biases are there. I recognize them. I do my best to recognize my biases and not let them get in the way of my trading. I get a little miffed when I hear the people, just trade the charts. And you have to have a bias. You have to have, sometimes, at least with me, my trading style, anticipate what's going to happen, anticipate which breakouts to take and which ones to not take because they're likely to fail. That makes a difference because otherwise, you take every breakout, especially in a bear market. You take out bullish breakouts, just like in a bull market. Believe me, I've been on the wrong side of this many times, taking bearish breakdowns of bearish patterns in a bull trend that was too strong, and either those short trades, just as they started to look good, reversed. Most didn't play out to their measured targets, or they proved to be just a brief whipsaw. You get the breakdown and the buyer stepped in. So I am, because of the charts, because of both the technicals and the fundamentals, which I just spoke to a little bit when I was talking about mortgages, I'm still sticking with my theory that we're in a longer term bear market. And just because we took out the 200s and the downtrend line, they are big, but they're not everything. And more important to me is, if you're going to get this, nobody right now, very few, I should say, I'm obviously generally speaking, very few believe that a big sharp 10-20% plus drop could be right around the corner. Very few believe it, and therefore that's why you need that to happen, because the way the markets work, if everybody's bearish and everybody's expecting something and the sentiment is very high, the sentiment survey and positioning, the market just can't go down. A stock can't go down. That's because you have a high short interest. You have a high short interest. Those shorts are the people that are, like myself, flexible traders, willing to go long or short. When they're all in, there's no one left to short. The bulls are already shaken out usually. And then those shorts, as I always say, are the only guaranteed buyers in the financial markets. Bulls, you could be a long-only hedge fund manager. Most individuals, people you talk to, some people listen to my voice, they don't short. For whatever reason, they don't know how. They think it's anti-American, whatever. They go long. And so they may be all out bullish, planning on buying, but they don't have to buy. They may see something that spooks them, something may come up, whatever. But it's the short sellers. When you short a stock, you must at some point buy to cover. That's how you close your position out. And it's buying it's the same as a long buying the stock. They're buying it and they're closing the position. That puts buying pressure. And so that's why you need a move like this. And again, I'm just saying, I'm not promising it will happen, but I'm saying there's a decent chance that this whole textbook breakout and back test would be the perfect scenario right now to see this happen. Because of the fact that it would have sucked in a lot of dry capital, whatever dry capital is on the sideline, meaning long money, deploying into stocks, and also blown out a lot of shorts that say, screw it, now we're above the 200 days. Clearly, we took them out and we back tested, and I was as a bear hopeful they'd break down, but they didn't, and now those shorts probably threw in the towel, and so there it is. All right, so. And again, how to trade it, many different ways. I always say this. You could have shorted the downtrend lines yesterday. You could have, always point out objective levels for both longs and shorts. If you were a bull, that's where you would have wanted to take profits yesterday. If you were a bear, that's where you wanted to short yesterday. And I also said that based on everything I've just talked about, as well as the fact that the VIX was also at support, I said this favored, this helped support the case that we could see a much bigger drop than the 2% or so we just got shorting, NQ or QQQ yesterday. There's on the daily chart, our primary uptrend line. That's the chart I gave you yesterday. This was our downtrend line right here, and this was our divergence line, formed a bullish falling wedge, breakout back test. So will the real breakout and back test step forward? Let's say that. So whether one of these two is going to be it. Either the stock market, that breakout and back test is going to be successful, and then the S&P will rally from here, and then the VIX will fail. And then this whole thing here, that breakout and back test or near back test, that will prove to be the bear trap, right? Bears got sucked in. But if this happens to play out, we start rallying up from here, that's going to coincide with a drop in the equity markets. And if we take out the recent lows, and again, we're just talking last week's lows, take them out with conviction, the VIX could explode. And, that's the nature of the VIX. I'm not trying to be dramatic here or anything. But, that would be a 70, just to the trend line right there, 76% return. But of course, it would have even bigger implications if we did that, because again, the only way the VIX is going that high is if the indexes clearly fail those breakouts, because I can only imagine how many bulls, how many institutional and individual investors, if they see the S&P fall back solidly below that trend line in the 200 days after the successful test, and that's where they bought, they would have bought here, they should have bought there, and I pointed those out as objective levels to buy. But so that's that. All right, I don't want to go round and round. I will wrap up here. A lot going on in the currency markets, obviously, with Powell's hawkish remarks. Gold, silver, get to all that as soon as possible. I just wanted to get this one out. And so in this video, just to recap, I give you both near-term, short-term levels in which to trade off of, actively trading, as well as longer term, and how to trade that. And I can't speak to each and every trader. Some of you are, maybe very active short-term traders trading off the intraday charts like me. Others may be just simple trend and swing traders, and I'm also that in other accounts. I have so many accounts I can't actively trade in each and every one. So usually the IRAs and the longer-term accounts, I'll position and trend trade on those. All right, let's wrap it up here, and yeah, I'll do updates later today. I'll get some other charts out to you on the other things, bonds and gold, silver, whatever else looks interesting. This has been Randy Finney with Right Side of the Chart. Have a great day.